All right, going through the last tool that the Federal Reserve has to control money supply, it's impacting the federal funds rate in the economy. So what is the federal funds rate? The federal funds rate is an interest rate, and it's an interest rate that a bank will charge another bank when one bank, let's say in an example would be like Bank of America, is short on reserves and it needs to borrow from another bank, let's say M&T Bank, and M&T has extra reserves. So M&T loans money out to Bank of America, and M&T then charges Bank of America an interest rate, and that interest rate that is charged is called the federal funds rate. And this is really how banks are supposed to get extra money if they're short on reserves. They're supposed to borrow from each other. So this federal funds rate is really the cost for a bank to obtain money. So the cheaper the bank can get the money, the cheaper it can lend it out. So if the federal funds rate falls in the economy, mortgage rates will fall, for example. Auto loan rates will fall because the bank obtains money at a low interest rate, then it loans it out or can loan it out at a low interest rate. If the federal funds rate goes up, then typically all the other interest rates will go up in the economy as well. So this is really the interest rate at which a bank can obtain its money at. The central bank, the Federal Reserve, has the ability to target and manipulate this interest rate. And we'll go through in a second how the federal funds rate is manipulated or changed by the Federal Reserve. So just so you can see here, the federal funds rate, so the interest rate that a bank charges another bank, and then other interest rates that you would see in your economy. Mortgage rates, prime is the interest rate that banks charge their best customers, and 3-month treasury bill is the interest rate on a 3-month bond. So if you just look at this, you can kind of see that as federal funds rate drops, all the other interest rates will drop in the economy. So the federal funds rate moves all the other interest rates in the economy. The central bank, the Federal Reserve, can target a higher or lower federal funds rate to try to impact the overall economy in the form of impacting the production in the economy, impacting the unemployment rate in the economy. So that's referred to as monetary policy, changing the money supply to, in this case, change the federal funds rate to either speed up or slow down the economy. So you can see after 2009, there was a real drop in the federal funds rate, almost down to nothing. So the central bank, the Federal Reserve, is what caused this. They targeted a low federal funds rate, so all the other interest rates dropped in the economy. And the idea then is that mortgage rates are lower, car loans are lower, and that this was meant to try to stimulate the economy. So low interest rates caused by the Federal Reserve, trying to then stimulate the economy. Now, as we have inflation starting to pick up, prices are starting to rise, the federal funds rate will likely increase because higher federal funds rates typically means higher other rates, like higher mortgage rates, higher prime interest rates. And what that does is it starts to put a damper on inflation. So higher interest rates, people don't try to demand as much money because it's just more expensive to access the money. So let's go through how the Federal Reserve can change the federal funds rate. So setting up a market for money, we have the demand for money, the supply of money, and then the interest rate for money. In this case, it's the interest rate of the federal funds rate. And what we're saying here is the Federal Reserve comes into this marketplace and starts to sell government bonds. So if they sell government bonds, what happens is they sell the bonds to Bank of America, M&T, and all of a sudden Bank of America, M&T have more bonds and they have less reserves because what happened was the Fed traded them the bonds for money or cash. So the cash leaves the banks, goes to the Federal Reserve. So the Fed is reducing the money supply in this case. So there's less supply of money. And what happens is if banks have less reserves, then they lend those reserves to each other at a higher rate. Anytime when there's less supply of something, the price has to increase. So in this case, the Fed, using that open market operation, comes into the marketplace, starts to sell bonds. As they sell bonds, what's happening is the bond is coming into the market. The Fed is pulling the cash out of the market. There's less cash in the market then, and what happens is interest rates start to rise. So they can, meaning they, the Federal Reserve, can get banks to lend to each other at a higher rate if they pull cash out of the system. Now, if they went into the market and instead of doing a sale of bonds and actually purchase bonds, purchasing bonds means that they buy up bonds from banks, and as they buy up the banks' bonds, then banks have more cash, the supply of money would increase. All these banks have extra reserves, so then they lend the reserves to each other at a lower rate. So this is the really the main way that the central bank changes the money supply in the economy, changes the interest rates in the economy, and therefore when these interest rates move, meaning the federal funds rates move, then all the other interest rates like mortgage and car loans will move as well. So this is monetary policy adjusting the money supply to impact the federal funds rate, and then either to speed up or slow down the economy by changing the interest rates.